Hi, I'm Chinsia Steddle. We're going to be doing question 2 now. So I hope you have it in front of you. Question 2 contained 3 parts. There was a part A, B, and C. So the first thing we're going to do is look at the required. The required for part A asked you to calculate the taxable turnover of Fly Away With Me, Pty Limited, for the year of assessment ended 28 February 2050. So this is a calculation kind of question. The term taxable turnover is something you need to understand. I'm going to stop there and just spend a few minutes explaining what taxable turnover is. Now, if you think of your tax framework, up until this point you would have calculated the taxable income. You start off with income, deductions, and you work towards a taxable income. Now you're thinking, oh, what is taxable turnover? Taxable turnover is specifically applicable to a micro business. Now, a micro business is a taxpayer that has turnover of less than R1 million for a year of assessment. They will pay less tax than other taxpayers. They only then pay tax on their turnover, taxable turnover. So this is very different from the tax framework that you've been working with up until this point. You don't look at deductions, you don't look at capital allowances, anything like that. You're simply going to look at what's included in taxable turnover. Our taxpayer is a company. That's fine. You can get various, an individual can qualify, a company, so that's all right. And anything that's happening in this year of assessment, you need to determine the taxable turnover. This was for 5 marks. So it's a quick, easy 5 marks, work very quickly. And let's look at then the scenario that was given to you. All right, it starts off saying that the company provides hot air balloon trips in the Drakensberg. We tell you up front that it is a micro business. They have the February year end, and then there's a summary of information provided to you with notes. There are some hot air balloon trips, for which they obviously received cash. That figure is something we need to work out. Then they earned royalties, and then there was a sale of a hot air balloon. All right, just something I didn't mention with taxable turnover. What is included in taxable turnover is purely cash sales. They don't look at transactions that occurred on credit. So we're only looking at what cash was physically received in that year of assessment. So in note 1, where we have to work out what the balloon trips income amount is, it says that there was a fee for hot air balloon of R2,500 per person per trip. Trips are only done on Saturdays, and then there's a whole lot of other information here. The customers have to pay a deposit of 50% in order to book the trip, and then the balance is paid within 2 days after going on the trip. During the year of assessment, 320 people went on hot air balloon trips. So, and then it goes on to say these persons enjoyed the trip on the last day of the year of assessment is not included in that figure. Then on the 28th of February, 10 persons went on the hot air balloon trip, and none have paid the remaining portion of the fee. So in other words, there's 10 people that paid their deposits but haven't completed the full payment. All right. But in your mind, you're thinking, okay, I'm looking purely at just cash that was received right up until the year, the last day of the year of assessment. Another 40 persons already booked and paid their deposits on the last day of the year for trips to be done in the following year. Okay, that needs to also be included. So it's all cash, even though those trips are going to only happen in the next year of assessment. The cash was received by the end of the year of assessment, so it needs to be included in your taxable turnover. So let's do that. Simply, this is now just mathematical calculation. We saw there were the 320 people that went on trips, so that's at R2,500 is going to give you 800,000. The people that, persons that completed but did not pay the last part of the installment, that was the 10 people at the 50% deposit that they need to pay. So that cash that was received was 12,500 rand. Fees received from persons that pay the deposit amount but are only going to go on the trip in the next year of assessment, but that amount was received. So that is the 40 people paying the 50% deposit, and that amount is 50,000 rand. Okay, these are all income amounts, so to get to the taxable turnover figure. So that's our note 1 done. Note 2, then if we look just at the note, it has given us an amount of 77,000 rand. What is this all about? In the note, it says that they have a registered trademark for the phrase up, up and away, and a company is paying them royalties, basically. A royalty that you receive is considered investment income. Now, for taxable turnover, if you're a company, which Fly Away With Me is, it's a Pty Limited, they have to include their investment income, well, 100% of their investment income. So they can include the full 77,000 rand as part of their taxable turnover. So we slot the 77,000 rand in. The third note dealt with the sale of a hot air balloon. Now, a hot air balloon for this taxpayer is considered a fixed asset. They cannot carry out what they do without this hot air balloon, and they sold one during the year. So 50% of that capital receipt is included in the taxable turnover. So 50% of this 50,000 rand needs to come in. That's 25,000, and that gives us a taxable turnover figure of 964,500. All right, so we've done part A of the question. In part B of this question, of part A, there were 2 parts. The A we've just done, and the B says assume now a taxable turnover of 970 for the year of assessment and calculate the tax liability for the company. All right. So now this company, like we said, will pay tax on their taxable turnover, not taxable income, which is applicable to other taxpayers. They're a micro business. They will pay tax on their taxable turnover. Now, a micro business has a separate tax table to determine what tax they will pay. So depending on what their taxable turnover amount is, they will pay different amounts of tax. This table will be in your study guide, obviously, and it will be provided to you in your exam paper as part of the annexes provided to you in your exam. So you don't need to know the table off by heart. You can simply just know how to apply the table. All right, let's move on to part B. Again, look at the required. The required says, list the requirements set out in the Income Tax Act in order to qualify as a small business corporation. Again, 5 marks. Okay, so here's a little bit of theory, and you should be happy. Theory is easy if you've studied it, obviously. Okay, so here we're just looking for you to list the requirements of a small business corporation. So part A, we looked at a micro business. Now we're asking you to list the requirements of a small business corporation. Again, a small business corporation, if they qualify in terms of the definition, they will pay less tax than a normal company. So here, just listing the requirements, nice and easy. Don't ignore theory in this module. We'll never give you, well, never say never, but we'll never give you a theory question for, say, 30 marks, all right? But here and there, 10 to 5 marks, we can easily ask you some theory. All right, I'm not going to go into detail now. You'll have the solution with you. This was quite straightforward. So let's move on to part C. Okay, straight away, go to the required. Part C, another calculation kind of question. Calculate the tax liability of Menora CC for the year of assessment ended, and there's your year end. Okay, this is 10 marks. So also, you should work quite quickly and efficiently. 10 marks, you shouldn't be spending a lot of time on this. Tax liability, okay, we're not sure now. What is this? Is it a micro business? Is it a small business corporation? Is it a normal company? Remember, CCs, closed corporations, are taxed exactly the same as if they're a company. So they will get the same capital allowances, same rules apply. But maybe there's a small business corporation here. So let's start reading the question. Minora CC, we tell you upfront, it's a small business corporation. Okay, so at this point in time, you should be telling yourself, okay, we're going to be paying less tax than a normal company. Small business corporations pay tax in terms of a table applicable just to them. So you're going to be using a special small business corporations table to determine the tax liability. And the other thing applicable to small business corporations is their capital allowances they are entitled to. All right, we'll get to that as we move on. Minora CC manufactures blades and other cutting products for 3 South African supermarkets. Okay, so we're going to have some manufacturing assets, most probably. Minora CC's year of assessment, we know that already from the required. And then we are provided with some information. Okay, so now we can just simply start working through each note. So remember, we're working towards the tax liability for a small business corporation. Now, they will follow the normal framework, tax framework. So we're going to start off with income, deductions, and work our way towards a taxable income, and then apply the tax table applicable to small business corporations to get to our tax liability at the end. Let me just get some paper to do the answer. Okay, so our first note just tells us what the sales were for the closed corporation. We had sales of just over 12 million, so that's income. Nothing strange there. We can include it. Note 2, they purchased raw materials to the value of just over 9 million. Raw materials can be deducted in terms of Section 11A, so it's a normal deduction we're entitled to. Can you see now I'm starting a bracket? This is now a deduction. That is to be added, that is to be deducted. Be very clear in what amounts you're adding and deducting. Note 3, on the 1st of July 2048, so this is something that's happened in the previous year of assessment, the CC purchased a delivery vehicle for that amount and brought it into use on the same date. The delivery vehicle is still in use in the current year of assessment. So this is telling you we need to work out the capital allowances or the wear and tear for this asset in the current year of assessment. Okay. Now, as I said previously, there's special capital allowances applicable to small business corporations, and I'm going to touch on that now. Here is a summary that I did on movable assets and all the capital allowances applicable to movable assets. So we are looking at this column over here. We are looking at small business corporations and what allowances they get. On manufacturing assets, we get 100% straight away. So that means you buy the manufacturing asset and you write it off 100%. There you go. So you claim that as a full deduction. So it's a great incentive for the taxpayer. Other assets are non-manufacturing assets. This can be computers, furniture, vehicles, any other kind of asset that wouldn't be used in the manufacturing of your product. Will qualify for 50% in the first year that is brought into use, the next year 30 and 20, and then it is written off. Remember, this these allowances will not be apportioned. Okay, so we're not looking at how many months this thing was in use or whatever. You write it off in full straight away. So even if that asset is bought on the second last day of the year of assessment, there's no apportionment. You can claim the full 100% for manufacturing machines, manufacturing assets, and then the other 50, 30, 20 for other assets. All right, so back to note 3. We had a vehicle that was purchased in the previous year of assessment. Okay, so I'm just quickly going to show you in terms of a timeline. Our year of assessment is here, running basically for 12 months over here. This vehicle was purchased in the previous year, in July of 2048. The cost price of the vehicle was 251,500. Okay. So now I've just shown you on this table, it's not a manufacturing asset, so we're looking at other kind of assets. In the previous year, we would have claimed the 50%. We're in the second year, so we're going to be claiming 30% of the cost price now. So simply doing 30% of that, and that figure is, I'll tell you now, is 75,450. Okay, so we're going to slot that into our calculation straight away. So the wear and tear on the delivery vehicle, the 30%, and this is a deduction. Okay, so we've done note 3. Note 4. Menora CC purchased a new manufacturing machine with a cost of 855 and brought into the process of manufacture, and the new machine was brought into use there. Okay, so this is a couple of weeks basically before the year of assessment. Remember, we're not really interested because there is no apportionment with a small business corporation on the allowances. We claim the allowance in full. It's a manufacturing machine. It's really irrelevant that it's new, okay, because it doesn't really matter to a small business corporation whether it's new or unused, because those are the things you should be asking yourself for a normal taxpayer. But for small business corporations, when it's manufacturing machines, we're not interested in new or second-hand or anything like that. The allowance can be claimed in full. So we claim the whole 855,000 rand. Our note 5, Menora CC now sold a computer in the year of assessment for 8,000 rand. And its original cost price was that. Okay. So now they went and sold an asset. So now we need to determine the tax value of this asset and whether there was a scrapping or a recoupment on the asset. Okay. So now again, we can just quickly do a little timeline. Okay, so it got sold around here somewhere, 15 January 2050. Okay. This was purchased in 2047, so already 2 years have passed. So in the first year of assessment, which would have ended 2048, we would have claimed 50%. Remember, it's not a manufacturing machine, so we're in that other option of going 50, 30, 20. Then in the next year of assessment, we would have claimed 30. And in the current year of assessment, we would have claimed 20% on the cost price of the asset, which was 14,500. All right. So you can actually see this asset has actually been written off. So the tax value is going to be 0. And then we'll take our proceeds or our selling price off that of 8,000 rand. And you can see immediately that there's going to be a recoupment. So this is all over here. I'm just going to plot the cost price of 14,500. The wear and tear for that first year was 50% over there. In the second year, we got 30%. That's the 4,350. And then in the current year, the last year, we're entitled to wear and tear of 20%. Now, don't forget, this needs to move into your current year's taxable income calculation. Okay, these were all claimed in the respective years. Okay, we need to now claim this one, the current year's figure. Our tax value, as I've said previously, was 0. Our proceeds were 8,000 rand. So the recoupment of 8,000 rand needs to be included in our final column of taxable income, because we need to be taxed on this figure, all right, on the recoupment of the allowances previously claimed. Okay, note 5 is done. Okay, note 6. During the 2045 year, okay, so this is a couple of years ago, the CC erected a new factory building at a total cost of 17 million rand, 12 million rand, just over 12 million rand, and it was brought into use. Okay, so the allowances here, just because it's a small business corporation, it doesn't mean they don't get the other allowances that are applicable to them. So here they built a manufacturing building. They're entitled to 5% of the costs that were incurred to build this manufacturing building. And there you have it. And that allowance figure is 637,500. All right, so it was. I just want to mention that even though it was, bought a couple of years ago, that 5% has to happen every year. So every year that you do your tax calculation, you're not going to forget about that. It doesn't just happen in the first year that you bring that building into use. Allowances are claimed every year until the asset is written off. Okay. Note 7. Menora CC experienced a lack of office space, and then they decided to purchase some part of a commercial building, and they paid 2.2 million for that. Again, they're entitled to an allowance. It's the 13 Quinn allowance. So the amount is on the cost that they incurred. It's the 5%. But because they purchased part of the building, okay, they weren't the ones that erected the building. They purchased it. The cost price needs to be reduced, well, not reduced. The allowance can only be claimed on 55% of the purchase price. Okay, so that's what that is there. Okay, if the scenario is different in the question you're faced with, don't times by 55%. Maybe in your scenario, they are the ones that actually go and build the building. Then don't times by 55%. You're only then going to, well, you can get 5% then on your full cost. Okay, I see a lot of students actually repeat calculations that they've previously seen in questions, that it tells us that you don't actually understand when to apply what. Okay, so be careful. Your scenario might be different in the exam. So that allowance gives you, comes out to 61,345,000. All right, and then you get to the end and you say, okay, wow, I'm almost done. What must I do again? Okay, I must get to the tax liability. So up until this point, you quickly add this all up and you're going to get to the taxable income figure of just over 1 million. Just make sure there's nothing that you missed out on. Maybe there was something you wanted to come back to. We covered all the notes. A little note there that you made, yes, I'm going to apply the small business corporation table. I covered all the notes. There was nothing I needed to come back to. Okay, so now you can work out the tax liability on your taxable income amount. So a small business corporation will pay tax in terms of that specific table applicable to them. So whatever their taxable income figure is, they will then pay different amounts of tax. You'll need to know how to just apply your tax figure into that table. The table will be given to you in your exam paper at the back in the annexures. And that's it. I hope question 2 was a good example of the differences and the tax implications for a micro business and a small business corporation.